I've been fortunate to find the clientele of owners who understand that we're in a bit of a down market right now, but we're not going to stay there. And it's the owners that innovate and bring on smart solutions when times are tricky that come out on the other end in a much more favorable stance, whereas the rest of the market is going to play catch up.
Phil Kanfer, founder of Market Lane Advisors, and I believe was the #1 revenue generator globally at WiredScore. Welcome to Change Order.
Thanks for having me. Hey, excited to be here.
I appreciate you coming on. I guess to start, people might be wondering why, I wanted to bring you on and have a conversation. Aside from your success at WiredScore, one of the ways that we got to know each other recently was through your work with a lot of large real estate families, real estate firms here in the city, and helping them make a lot of different Proptech decisions and decisions on what products they should be buying. And so I think in many ways you're kind of like the buyer whisperer here in the real estate ecosystem. So excited for this conversation. Maybe just kick off, and I want to take a step back to WiredScore. Like, what is WiredScore, and why is it such a successful company?
Yeah, so WiredScore, the easiest way I like to describe it is think of it like a lead for technology. So the reason why we started the business at the end of 2013 was we were seeing an influx of tenants coming to New York City from the West Coast, San Francisco, Seattle area, a lot of the tech tenants. And they were coming to New York and they were looking for offices that could meet their technology requirements, right? High-speed internet providers, ability to use my cell phone even if I'm on the 40th floor, things like that. And from my time at Newmark being a broker, I was touring tenants around New York City, and I was always getting the questions from tenants about, how will we be able to use technology in the building? It's generally a black box, so there's no transparency around it. So the idea behind WiredScore was to bring transparency to the ecosystem so that people can make smart decisions, right? Tenants could finally make smart decisions as it relates to buildings that meet their technology requirements. And on the other side of the coin, owners who've invested in their technology can now have a platform and a way of communicating that to their end user.
Super interesting. And so why did WiredScore represent an interesting stepstone for you to then launch your own business?
So, doing what we're doing at WiredScore, I had the opportunity to be on the phone with asset managers and heads of leasing in the C-suite every single day. So learned a lot about their pains and the areas that they're focused on. And what I realized over doing that for 9 years was most owners didn't have someone internally to kind of steer them through the buying process as it relates to project. It generally falls on the plate of an asset manager or leasing someone who decides to pick up the phone that day and answer the email or take the demo. And then because that person did that, guess what? They're now the tech person. But they don't have a background in it. They might have an interest in it, but they don't have a background of the time to do the diligence properly. So I noticed this, and I started to notice recently companies like a Brookfield, companies like a Blackstone started getting these, what's called head of innovation, which is a title that never existed before in real estate. So they started to get this title and this role in place, but I'd say 98% of the owners out there don't have that role, they don't have that muscle, but they're looking to innovate. They're looking to bring in technology that allows them to streamline their business and cut costs and do all the things that Proptech does. So, talking to the owners that I was talking to and doing what I was doing every day at WiredScore, I noticed this gap that existed in the market. Someone internally at most of these companies to help steer them through the myriad of options that are out there. And that's why I started Market Lane, was to basically be that outsourced head of innovation, that person that they could lean on and rely on to bring in smart ideas and help them kind of sift through the noise.
So for context, what types of real estate folks do you work with today?
So I'm currently working with owners that have office, multifamily, and industrial buildings. So my clientele right now has over 50 million square feet of office, over 12,000 units, a bunch of industrial as well. So it kind of spans the gamut a little bit.
Mm. And is it a mix of institutions and families?
It is. It's a mix of institutions and families that own buildings, from New York all the way to California.
That makes sense. So when you think about the processes, the buying processes of institutions versus the families in the real estate world, how do they differ?
So with with families, what I've seen is you can generally get to the buyer quicker, right? You know what it is, their name's on the door more or less, right? So you can generally get to the buyer quicker. What I've noticed though over time is families, they're just more risk averse. Right? I have the pleasure of working with a family here in New York City, a well-known family who's a pleasure to work with, and they're very innovative and they're very tech forward. But I wouldn't say that's the norm. I would say for most families, their job is to kind of not burn the house down. So taking the risk is trickier for them. With an institution, they're more willing and acceptable to put a pilot program in place or start something. Because if it doesn't work, they have the resources to make sure they don't go out of business, right? So I see the risk tolerance for institutions is a little greater. Decision by committee across both families and institutions. But again, if a family sees something and they like it, they can act on it quick and they can shorten the sales cycle. With an institution, even if they like it, they're going to bring in different stakeholders, they're going to bring in different people, potentially partners, a little bit longer of a buying process.
So most founders, when they're trying to go to market and sell a product, they're trying to figure out scalable ways to, acquire customers, reach out to them, etc. If I'm going and entering into the real estate tech world and I want to go sell into a family, should I be doing cold emails or should I really just be reaching out to and finding ways into the person whose name is on the building?
Anything you can do warm is always suggested. People are inundated with cold emails all day long. Cold emails from people trying to send them things. They're getting flyers from, if it's on the office side, office space that's up for lease. People are getting tons of emails every day. So, warm intros are always the best. Checking your LinkedIn and going through your network is obviously preferred. But I've also seen strong cold emails that are ROI driven and they focus on customers that are near and dear to that particular owner that you're trying to sell into. But yeah, look, like with families, I think going direct, whether it's to the person whose name's on the door or the daughter or the son, it's just, how to navigate it a little more clearly than you might with an institution.
That makes sense. And one of the things that I feel like most sales leaders constantly debate or founders debate, and we debate internally, is when you're going out and you're making new sales hires as a founder, do you bring in a person who is an incredible SaaS salesperson? Or at times I've heard in the real estate world, maybe you should just bring somebody in for their Rolodex and you can teach them sales. If you were starting a company tomorrow, would you optimize more for the Rolodex or for the sales skills?
For the sales skills, for sure. We've had experience at WiredScore, just to bring that up, as an example of hiring people for their Rolodex. And the interesting thing with that is the people in your Rolodex generally are the people that aren't going to buy from you. And I've seen this at different stops along my career. You come in somewhere, you have a Rolodex, or you see people that come in with a Rolodex. Generally not the people that are going to buy at the end of the day. For a multitude of reasons, I like to hire for sales skills, what they could bring to the table, their tenacity, their grit, their hunger.
That's awesome. You mentioned one thing earlier, which is that there's a perceived risk in buying Proptech, which, especially if you're a real estate family and you want to reduce your amount of risk, then they might be more risk averse. Do you think there are certain categories where the idea of risk is just lower and the reality is that the perception is not the reality? Like there isn't actually any risk in making a certain buying decision?
Owners like to go with opportunities and platforms that are tried and tested. What I prefer not to bring to my clients are opportunities where they don't have a clientele yet, where you can get real-time feedback on if the platforms are working or not, especially in this market right now. Right? Owners aren't trying to make or take a leap of faith. So what's key to my process is, my process is pretty lengthy, but one of them is obviously customer reference checks, right? I don't want to bring anything right now to a client that isn't used and tested in the marketplace. So I think in order for us all to feel comfortable that this is going to work, it's where is this working already right now? It doesn't mean that this needs to be a company that's been around for 10 years, but is it tried? Is it tested? Is it proven? And is there demonstrable ROI? That's what owners are interested in evaluating right now. They're not looking again, and I'm going to talk about this climate that we're in right now, they're not looking to take on more risk and a platform that is looking for its first client.
I mean, it is 2024 and like interest rates are up. The real estate market is a very weird spot. Are people really making new buying decisions here?
They are. It's interesting. Starting when I started in January of 2023, in the midst of all this madness, which I guess, people say you can get through this time right now, you can get through any time. But I've been fortunate to find the clientele of owners who understand that, listen, we're in a bit of a down market right now, but we're not going to stay there. And it's the owners that innovate and bring on smart solutions when times are tricky that come out on the other end in a much more favorable stance, whereas the rest of the market is going to play catch up.
And to that point, I imagine there are some categories that are more interesting than others to real estate owners at the moment. What are the categories that are getting people to move and make a buying decision today?
So we talk about demonstrating ROI, right? So you'd be surprised if you look out, and we're sitting here in New York City, right? If you look out the window and you look at all these buildings, 500,000 million square foot buildings, you probably look at them, they're in Midtown, you're like, these buildings have everything, from a technology perspective. Many of these buildings are quite behind, right? So we could bring up one topic, right? Like one topic that I think a lot of owners are focused on right now is energy management. Whether you're in the multifamily space, whether you're in the office space, even in the industrial space, owners are looking at what are ways that I can cut my utility spend? What are ways that I can cut costs? And I think we've spoken about before in the past is there's not a ton that you can do at the physical building to take your dollar and turn it into 90 cents. Mm-hmm. So I think that's an area that owners are interested in and focused on because we're all looking for ways that we can cut costs right now or create efficiencies. So I think energy management is a really interesting space right now. Now, some owners could be listening to this and be like, energy management, like we've been on this for years already.
Yep.
But I will tell you, for someone who speaks to owners every single day, most are behind and most don't have a solution. So I think that's one. I think another area, look, I'll talk about AI not because we are mature yet in that industry, because we're not at all, but any AI solution that is automating routine, mundane tasks, I think are in a favorable position right now. So we talk about, I've seen platforms on the invoicing side. I've seen lease abstraction platforms, right? Things where we can take lots of information and documents and pare it down in a way where if I need this information or I need a data point, I can get it in the snap of a finger. So I think those are areas where, like, how can we take large data sets, bring it down to a place where I can get that data point instantaneously and also have the accuracy combined with it, which, by the way, not everyone is there yet either. That's, I think, an area where a lot of owners are focusing.
Yeah, AI has been fascinating to watch in the real estate world, I think, of late. One company that's done exceptionally well is Lease. That's a business that's been able to help automate a lot of the leasing process. And I think they've just been way ahead of the curve versus many of the other players, even outside of real estate, in terms of client communications, let's call it. And that is a repetitive task that might not necessarily need an incredibly strong salesperson to set up showings and figure out when is the right time to schedule a person to come in to look at a unit, for instance. So I agree.
Yeah, it's a space, and I get the question every day, what do you think about AI? I think it's a space that we as people in the real estate community, it's going to take some time for us to feel comfortable with it. But again, automating things that take us a lot of time, we're spending a lot of resources on, where the accuracy is also there, is important, because if you have AI but you don't have the accuracy, it doesn't matter, right? Like that's the key.
It's interesting though, because a lot of data is challenging to get for real estate owners because their systems internally are just a complete mess, right? Like you had Yardi and MRI and Entrata and Appfolio, and I just feel like any CFO you talk to, whenever they get into a new place, they're just like, the data's all over the place and nothing talks to each other. So does there need to be really a solution at maybe like the middleware connectivity layer in order to even unlock AI? Or do you think that you just have to kind of create many point solutions along the way and clean the data, that's coming out of whatever system like
getting to a really interesting topic that a lot of owners are wrestling with, right? So I think having many point solutions at the end of the day is what owners do not want. And you mentioned Yardi, right? If we talk about Yardi, there are some owners that if you don't integrate with Yardi, we can't even look at you, right? Because we're spending all of our time in Yardi, spending all of our time in our property management software. And if the systems can't talk to each other, it's not helpful for us. And some of these companies like Yardi, they'll make it difficult. They'll make it difficult to integrate, which is challenging. It stalls innovation as well, and it stalls acceptance in the real estate industry. So I think ultimately, in a perfect world, Yardi makes it easy or easier for these Proptech companies to connect to their systems. If they can, I think you start to see acceptance and adoption jump up and take bigger leaps than we've seen in the past.
You mentioned it's very hard to integrate into Yardi. I mean, I've been in this business for about 9 years now, and I remember one of the first investments I ever made when I was at Alpaca, which used to be called Corrigan. It took them months and months to get that done, and it was expensive. Meanwhile, I was just in a board meeting last week with a portfolio company of ours, Grips, and you're hearing the exact same thing pop up. Do you think that's intentional on Yardi's part?
I think part of what Yardi is trying to do at the end of the day is part of why they're not making it super simple, in my opinion, for these Proptech companies is I think they want to keep the door open for them to build it themselves. And that's not a groundbreaking statement, but their queue of ideas is, tremendous, right? So they might say, hey, we're in the process of working on this integration, and they'll put you off for a while because they're going to be thinking internally, hey, is this something that we could be doing for ourselves? Should we build this? And I think that's problematic. I think that's problematic right now in the industry. And I think that's, you say a company like Grips, which is really interesting. If Grips can't connect into Yardi, it makes their sales process really, really difficult. And you have an interesting company like them that can't move forward at the speed that they want to with their potential customers without Yardi giving them the blessing, and Yardi's just been massively reluctant.
It's fascinating because vertical software companies, at the end of the day, should look into real estate to see what the future looks like. Because PMS systems, property management systems, the Yardis, the Entradas, the Real Pages of the world, Appfolio included, you've got 3 companies close to $1 billion or more of ARR. I mean, Yardi is an elegant SaaS company that most people don't even know the metrics of because it's privately held. But they've done a good job of keeping things tight and then launching new products time and time again. And then what I think the challenge is, and candidly, I think it's going to be interesting to watch play out, is Yardi should be opening up the ecosystem where investors need multiple integrations. What do I mean by that? Yardi, Appfolio, and Entrada might actually have the same fund on with properties that managers use each one of those different things. And as a result, the owner, the funds are not going to be happy when they can't look at things because those 3 systems don't talk to each other. So I think we need to get to a place where those systems admit what should they be opening up and creating their own app ecosystem like a Shopify has historically, and what should they continue to keep closed because they want to continue to increase that average contract value.
100%. I see that with my clients who have some properties with Yardi and some with RealPage, some with different partners. And you're right, there might be one integration with the RealPage that Yardi doesn't have. And then all of a sudden, you can't look at the data the same way. And that makes it very difficult to manage your assets.
In a way, the vertical SaaS PMS systems in real estate are exactly what Epic is to healthcare. It's they're not letting you get the data out that you truly own, which is really hurting innovation and hurting the customer experience.
It does. The biggest thing is the end user is the one I think that loses at the end of the day because it has to start at the top, right? It funnels down to the end user. But yeah, the end user struggles, real estate organization struggles, and we're starving innovation. And I 100% agree. And I hope that we're soon in a world that the integrations that these companies are trying to make with the Yardis and RealPage of the world are a lot more seamless.
So to shift gears for a second, you mentioned energy management. How much of this decision making around energy management is because of regulations, for instance, here in New York City, versus, to your point earlier, we want to take something from $1 down to 90 cents?
So I think number one right now is reducing OpEx. Decarbonization is important, and coming into compliance with local law is something that everyone is focused on as well. But it has to be a little bit more than that. If owners are going to spend money on a software or a platform that's going to allow them to, decarbonize or reduce costs, like their focus first is what's my ROI. Right? Like, yes, we want to come into compliance. Yes, we know that's important, but for the people that I speak to and the customers that I chat with, it's about, again, bringing that dollar down to 90 cents.
I gotta ask you a question. Is actually getting into compliance that important?
The conversation is not as loud as I expected. Now we have some time, right, till 2030, right? The conversation I would expect would be louder. It's not something I hear every day from my clients.
Behind closed doors, I feel like there are many conversations going on around compliance, and one of them is that the fines are going to be maybe easier to avoid, or they're going to have to change the fine structure. This will never work to make all of these changes to buildings.
Yeah.
Are you hearing similar things? Do you see similar things popping up where I guess people aren't necessarily as afraid as the headlines in the news?
I think that's true. I think people are not as afraid as the headlines that are in the news. I mean, when I go over different platforms and solutions that are in that space with my clients, it's not, well, we have to do this to get into compliance. It's, okay, so we're spending $1 million a year on our energy bill, and now we're going to get to spend $850 or $900. That's appealing. So you would think that because of what's going on with regulation and coming into compliance, that it's that first, and it's not.
So let's use this whole energy management thing as an example. I already mentioned you were the #1 producer at WiredScore for quite a bit. What does a great sales process look like when selling into real estate owners?
I think if you're early on as a company, founder-led sales are incredibly important. Not for the first 6 months or the first year, for the first few years, right? Owners want to speak to the founder of the company. They bring a level of gravitas with them, right, and importance. So I think that part is crucial, founder-led sales. Being able to solve a pain point, right? Well, there's a lot of companies out there that are not solving a true pain in real estate. And I come across a lot of these. And you're laughing because I know you probably see a lot of these as well. It's understanding your prospective client and getting a gauge of where they're seeing pain. Question-based selling, right? Like understanding your customer. So I think as it relates to founders and owners that are getting started with selling or in their beginning stages, it's being able to uncover a pain. It's being able to communicate ROI in a clear manner, which many can't. And it's being able to navigate an organization and know who the key stakeholders are. Real estate, again, it's all decision by committee. Mm-hmm. So being able to understand, okay, who is in this committee early on and educating them. And then look, at the end of the day, it comes down to grit, persistence, professional persistence, and hustle, right? Like a lot of the times owners aren't avoiding you. You send them an email and then 60 seconds later, there's 10 more and now your email's gone.
Totally. I mean, I invited Michael Rubin on the change order, and he's going to be joining us in a few weeks. And I think I sent him 2 or 3 or 4 emails. You have to be persistent. People are busy at the end of the day, and it doesn't matter if they're in venture, they're starting their own company, or they're in real estate. People just have different priorities. Doesn't mean that they don't want to help or they want to take a look at something. You just need to actually grab their attention.
With my time at WiredScore, I made thousands of sales. I led sales and revenue for across North America. My phone didn't ring. We would get the largest owners. I would sell to the largest owners in the entire country, and still my phone didn't ring. So everything came from outbound. Everything came from being persistent and staying on people. Again, we're not sending them emails or phone or picking up the phone every day or every other day. It's just, what are you doing to stay in front of that customer? So the best sales processes are ones where like you're highly organized, you're highly calendared, and you're doing things in a smart way.
How many meetings does it usually take to sell into the owners that you work with?
For Market Lane?
Yeah.
Generally takes 3 to 4, I would say. You're usually having, a conversation with the first supporter that you find. What they'll do after that is they'll probably bring in another colleague. You have another conversation there. Then they'll bring in the lead decision maker. And then after that, you might meet with the entire team. So I would say probably 3 or 4. And if you talk about with WiredScore, similar-ish, less of a buyer committee, right? You're usually talking to someone in asset management or someone in leasing, and they would understand the concept and they're able to make a decision relatively quickly. You don't need the entire organization on that conversation. Yeah, I'd say about 3 or 4.
And does that number of meetings differ between institutional real estate investors and the families?
Yeah, I definitely think it's shorter with the families. And it probably goes back to my point earlier, right? Like if you can get to that person whose name is on the door and they're interested, it's probably 2 to 3. Again, like we're not going from 3 to 4 to 1. We're probably just shortening it by a meeting or 2.
So if I'm a founder out there listening to this and I'm super optimistic about my new Proptech startup and I'm ready to start pitching people, how long from the first meeting to getting a contract signed do you typically see these processes play out?
Typical, I'd say, is about 3 months. I've certainly, it's not awful. I've seen longer, but 3 months is generally the time frame from initial conversation to contract signing.
When you were at WiredScore, was there any tricks of the trade or things that you did that helped make you super successful aside from being super persistent?
Look, I'm someone who's highly calendared and extremely organized when it comes to sales. Any single time I send out an email or I make a call to someone, I'm creating a task as a follow-up. Like that's, in my blood, right? Because I know that these are busy people. They're not going to always get back to me. And I want to make sure that I'm staying persistent and continuing to stay in front of them. So as soon as I send a note, I'm scheduling a follow-up. That's really, really important for me. An old broker trick that I have is just like mixing up times, right? Like trying to figure out when people are around. I might call someone at 8:30 in the morning and they don't answer, and I'll schedule my next follow-up for 2:30. And for if I'm reaching out to someone at 8:30 in the morning on a Wednesday, next week I might follow up with them at Tuesday at 3 o'clock, and then I'll switch that up if they don't answer and switch the times around. So I'm always trying to find out, like, when can I get them to be most responsive? Maybe the early morning doesn't work for them. Maybe it's late afternoon. I think that's one thing. The other is I try to keep my outreach between Tuesday, Wednesday, Thursday. Monday, people are trying to get their weeks, in order. Fridays, people are still a little checked out, getting ready for the weekend, especially in the summer.
It's time for the Hamptons.
Exactly. But Tuesday through Thursday for me is the window that I like to do my outreach.
Were you doing calls to people as a prospect, or were those mainly to push processes along?
I am generally an email person, especially in this post-COVID world where you don't know when people are actually going to be in the office. So I'm generally email. I will mix in a call every once in a while. I think when people, and by the way, I'll leave a message, which most people don't leave messages anymore. I'm not the person that's going to text a prospect. Actually, I'm against that. I think that's invasive. I've even had a client recently say to me, this company is just too much because they're texting our asset managers, which people do. I think that's too much. But I like email, and if I'm not getting a response, I'll leave a message followed by an email. I think when you do that, people say, okay, he's really trying to get in touch with me. But I mix it up, but err on the side of email.
Did did you ever try the whole sending a prospect a gift thing? I mean, we've seen companies send bottles of champagne. My partner, Sam Toole, used to send, I think he sent an RC car to one of his prospects, but he didn't send them the controller.
100%. I have walked into offices when I wasn't able to get a meeting, handwritten note for whoever it was. Hey, stop by. We'd love to connect. Bring a nice bottle of wine. For sure, I've tried it all. There isn't a silver bullet like if you do this, you're going to get the response. But I think the gesture is meaningful, and I think people respond to it.
I think the New York real estate community is more of a fan of scotch, right?
Yes, bourbon, scotch for sure.
So we've gotten to know each other, and we've chatted about different categories of late. I'm trying to avoid a bunch of zeros. We were very concentrated fun. Are there certain things that you say to me, like, hey, Jason, definitely be mindful and probably don't dip your toes into these categories?
One of the categories that I've seen a lot in, and I think it's just very, very noisy, relates to ESG platforms. Ways to understand your data and ways to report on it. I think they all look alike, they all sound alike, and even heads of ESG have a very hard time telling the difference. So again, I don't know how much you're playing in that space right now, but ESG monitoring platforms and data intelligence reporting tools, there's tons of them. I've come across a lot, and you really have to go through them with a fine-tooth comb to really understand what the differences are. So to me, I think that's a space that I don't love just because it's the heads of ESG don't even get it. They get it, but there's too many platforms for them to even wrap their head around.
I think it's one of the hard things about startups these days, though, where certain categories are getting incredibly hot, incredibly fast, because most founders know that if they hear about a regulatory change or a regulatory shift, that typically presents opportunity. And when opportunity is heard, founders start companies, they go after the same problem set, they start going after the same buyers become overwhelmed. And typically what happens is it's hard to break away from the pack. And so oftentimes, we talk about a venture, you need to go after alpha, which alpha is oftentimes being contrarian until it's no longer contrarian, it becomes and flips to consensus. In these markets like ESG, where essentially these products are already consensus now, I would recommend to founders to just stay away from them unless they have an absolutely incredible unfair advantage.
I also think that Proptech founders don't spend enough time with real estate owners. They don't listen to them enough. I think that's a very big disconnect. You want to come up with some smart ideas and understand how to properly sell into that prospective client. Spend some time with an owner, understand what they're working on and what pains them. I think a lot of times founders are so entrenched in their own world, in their own new idea, that they think it's a fit for anyone that they speak to. And I think that research is paramount, and spending time with owners, as many coffees and lunches that you could get on the calendar with them to refine your product or understand what to build is essential.
I want to double down on that for a second. I think far too many founders these days, it doesn't matter if it's in Proptech or any other category, they're not spending enough time with customers. And I actually would argue that VCs are hurting that problem and making that problem even worse, because a founder goes out, they hear about a regulatory shift and why ESG needs to be the next thing and reporting super important. They know a little bit about real estate, or maybe they don't, but they find it interesting. So they're like, I'm going to go into this vertical. I'm going to go launch a company. And then they go and they pitch one of these, hundreds of new seed funds. Maybe the investors don't have previous investing experience. Maybe they do. And a lot of people just aren't doing the work, and then the investors are giving them capital to go run after this thing, and they spend the next 12 months talking to customers and building product maybe, but it's too late at that point. And so here at Primary, when we're incubating companies, which outside here we have a dozen folks that are working on new things, we end up making sure that we're talking to almost 100 customers on any new product launch. And we want to get design partners before we launch a business to make sure that we have traction and we have product market fit. Whereas I think a lot of people are committing to the next 18 to 24 months of their lives and taking capital from VCs who have capital from nonprofits and universities and pension funds and putting them to work in things that probably should be more validated than they are.
And that is the customer research that you're doing here at Primary is the most important thing. The most important. Before deploying capital, talk to the buyer. Is there pain there, and is this potential new tech solving for it? And I think that's critical.
In the real estate world today, are people optimizing for making more revenue or lowering costs?
I mean, the easy hedge is both, right? I mean, obviously everyone's looking for new tenants, right? Like they're looking for new revenue opportunities. I think what we're doing right now in real estate is owners are really focused on areas that I can reduce costs, right? Like new revenue opportunities are super important. Areas that I haven't thought about in the past that I could reduce costs and lower OpEx and potentially even lower headcount, right? Like we've taken this team and we've fattened it up to 4 or 6 people, and now there's potentially new technology that allows us to not grow that team anymore or bring it down to 2. Like how can we be more efficient with our personnel? Owners are definitely keying in on areas that we can cut expenses and cut costs, because CFOs right now are scrutinizing everything. They're scrutinizing everything. That's their job, but they're scrutinizing everything. They're negotiating hard, and if you're not willing to play ball, I think it's very difficult to get your products sold.
You've sold into a lot of impressive people. I'm sure you've met a lot of impressive people in the real estate world. Who would you say is the most impressive person that you've ever met in the real estate world, and what made them so impressive?
So there's a guy at Brookfield, his name's Ali, and he, to me, is very impressive. He used to be at Far City, came over to Brookfield after that acquisition, worked at various sides of the business. Highly intelligent, but also very accommodating. He's open to new ideas. The way he thinks about real estate, the way he thinks about technology and its applications, like he puts a lot of thought into things. Ali at Brookfield is probably, I don't want to butcher his name because it's a long one, but if you know Ali at Brookfield, to me, he's one of the most impressive ones that I've come across.
Well, looking forward now, 2024 to 2030, lots of stuff's going to go on in the real estate world that we probably don't know about. But any predictions on the Proptech side of things and what you think will come to light here?
I think we're going to start to see a lot of consolidation in the space. We'll see consolidation. We'll see some companies that have to close up shop because they've run out of funding. But I also see, look, there's an article that came out, I think, last year that said the Proptech market's growing from a $20 billion market today to about $105 billion by 2032. What we're seeing in the market right now, what we've been seeing over the past 10 years, is a little bit of a switch on the real estate side, the old guard to the newer guard, right? So you're starting to see fresher faces in the decision-making chairs. And I think as you're seeing that, and they're more receptive to technology, you're going to start to see adoption pick up, right? Like as we get out of where we are right now in the market, and now that we have fresher faces and younger faces that are leading these organizations, people that grew up with technology as opposed to their parents, where it was a little bit more foreign to them, I think you'll see adoption and the acceptance of PropTech ratchet up a bit. And I think that's really, really exciting. That's when we were at WiredScore, starting at the end of 2013, it was, we weren't there yet. We weren't there yet in terms of the older generation retiring and the new ones coming in. And I think we're now at that point. For me, that's exciting because that will foster more innovation and more adoption.
I agree. I would also argue that the next generation of PropTech companies shouldn't be called PropTech companies. They should be called SaaS companies like they are. And I think we talked a little bit about data earlier. I think that the visibility into data will be a huge thing. And I see it across really 2 categories, one of which we talked about before, which is data management, for construction projects. And then the other, I would actually argue, is going to be more around like fund administration and like the CFO suite. They're massive categories. And to your point, these real estate families, these asset managers, they have friends running other companies in other industries. And when they talk to their friends who are also successful, and they hear about the dashboards that they get to look at on a daily basis and the insights that they get into their businesses day to day, they start to think, oh man, wouldn't it be nice if I got that exact same amount of information?
And they're there. I mean, there are these data analytic companies that are built, and they're impressive. So I certainly agree with you. We'll start to see more and more of that, and hopefully we'll start to see people move off of Excel and into the new age where they're able to visualize these dashboards and consolidate things in a way where they just haven't been consolidated before.
Totally agree. Well, thanks for joining me, Phil.
It's a pleasure. Always.
Appreciate it.